In this episode, we discuss exactly how to build a proper infinite banking policy, and we answer the most common questions that we get about policy design. She's Holly, and she helps people find financial freedom.
He's Nate. He makes sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered.
If you're new to infinite banking, or if you're just starting doing research on this concept, there's so much that you can soak in all of the online world and YouTube and Google searching and whatnot. What Nelson, the phrase he would use is there's a lot of noise in the financial world. There's always people trying to vie your attention, say they know something that other people don't, or they got some special new thing. And that definitely applies to infinite banking. There's a lot of people out there who say they finally figured out how to do it the best. There's people out there who say it never works for anybody, don't touch it. A lot of noise out there, whether to put a term rider on the policy or whether not to, with all these bells and whistles. So what we wanted to do today was get back to the basics, the foundation of what makes a proper Nelson Nash infinite banking policy, because that needs to be the core. All these crazy things that people think about, they can work for some, but I don't think it should be for everyone. Most people, just the basic understanding of what you need is going to produce the best result. Simpler is normally better, and simpler puts you in more control. So that's what we wanted to talk about today, and we're going to dive into how to build a policy to maximize the infinite banking concept and do its best. And I thought we could start by mentioning some things. You know, a lot of the naysayers, especially just the generic ones like a Dave Ramsey who says, you know, don't use a whole life insurance, they have complaints about life insurance policies. But you and I, Holly, would say that we think they're pretty misled, or maybe we would even agree on them for like the generic old
policy. Yeah, I think that a lot of times when Dave Ramsey or a financial professional is looking at even a traditional policy or a universal policy, when you look at it and the way it's designed, and most agents even design it, it's not a great policy. It is primarily set basically for death benefit. And so you see zeros in columns where there is no cash value for a lot of years. And what happens is it doesn't look like a good policy, because basically the only benefit of it is that when you graduate from this earth, somebody gets some money.
Yeah, you get a big death benefit. You're exactly right. The old school, most simple way to build a policy is just what's called base premium. We're just put all your money into this policy for the whole life insurance element, buys a ton of death benefit. It does build cash. It does build cash flow, but it takes forever. And it doesn't never look really that great. So I guess we would agree, Dave and me would agree.
Yes.
That, yeah, I mean, the average Joe, you go down to the street corner lot and you just walk into an insurance agent and ask for a whole life insurance policy. It is not going to look great for cash value. It has to be built in a specific way in order to really flush it with cash and have it really work well. That brings us to a common question that you would want to ask is, you should probably ask this to yourself. Some people, they think that they do want a death benefit. And we're not against death benefit. Death benefit is great. You're going to get a death benefit with this policy. But the question you need to ask yourself in every walk of life, what's more important to you, cash or death benefit? And I have yet to find a single individual, whether there's a 20-year-old with a new family or an 80-year-old who's, you know, getting closer and closer to graduating this world. None of them say, I think about dying all the time. But every day, what do we wake up and think about? Money, yeah, cash. It's always going through our mind. And so when you're building a policy, the best way to do it is not to have it focus on death benefit, but it needs to focus on cash value. That is the most important element for a policy, especially for the becoming your own banker strategy.
Well, and if you think of it, it's called the infinite banking concept. So, and you have to view that as it is a bank. You are starting your own bank. And what does a bank rely on? A bank relies on cash. A bank doesn't rely on a death benefit to give them money. They rely on the deposits that are taking place. And so that's where really that difference comes in. And it's a change in your mindset of, yes, you can still get death benefit because that's a bonus, we like to say, or the icing on the cake. But you need money today, you need money tomorrow, and you're going to need money in the future to live on. And that's the bottom line for anybody, regardless of ages. As long as you're still living, we need cash today. And that's the importance in the design of the policy that where Nate and I would agree with Dave Ramsey that, hey, if it's a traditional policy and it's just base premium, which is just paying for death benefit, you're right, it doesn't look so great. So that's what we want to talk to you guys about. How do you get that cash, Nate, into a policy that's essential for the design and avoid the noise?
Exactly. And I think it's funny that you said, it's called the infinite banking concept. Banks buy this stuff all the time, and they don't buy it for death benefit. So the big, Bank of America, Wells Fargo, Chase, whatever any bank, they own what's called BOLI, bank-owned life insurance. And those policies do have death benefits, but they are bought the same way that we would suggest you buy it. And I find it surprising how many clients I run into that may already have policies that they thought were infinite banking policies. And then they send them to you, and you're like, this is not the way Nelson had intended. It may be with a mutual company, but once again, there's a lot of base premium, very little PUA rider. And most of the time when you see that happen, it's probably because an agent wanted to get a higher commission than what, because the death benefit, the base premium is really what drives commissions to an agent. So it is true that as agents, we take a huge reduction in commission in order to sell policies that are very cash value centric. And some agents just aren't willing to make that hit. It's amazing to me that you'll see policies like this and it's like, this is banking and it needs to be cash value. Death benefit is important, but there's this creeps in this human life value discussion, or, if you make X amount, you should really own this amount of insurance. Let's solve for that first. And then if you have anything left, we'll add it to the cash. Cash value should always be the focus when dealing with infinite banking concept. And we can transition. How do we put cash value into a policy?
It's called a rider, so it's one of the bells and whistles, but this is what you do want on your policy, and it's called a paid-up addition rider. It is what generates cash. It is maximum cash, minimum death benefit. So it's buying you a little bit of death benefit, but it's giving you cash for you to use today. And I think that's the key, is that cash. And like Nate said, you can have an infinite banking policy, but it's a whole lot of base premium and no cash value, or the minimum cash you can have. We want to try and get to a place where you actually have a maximum cash and a minimum death benefit. And it's
like a teeter totter.
Balance,
you can weigh the death benefit, and you have a lot of death benefit, but not as much cash value, or you can weigh the cash value and you won't have as much death benefit. So if I came in and I said, I'm going to put in $10,000 a year of premium as a nice, easy round number, we could put it all toward the base premium. It will build cash over time. But this is the policy that even Dave Ramsey has an issue of, that we would agree with, is that it takes forever to get anything. The first 2-3 years, you probably have $0 of cash value. And it takes forever for it to really produce much, and it never really takes off. But if we took that same 10,000 and we started to split it up, where we don't put all of it towards the base premium of a policy, we put a vast majority of it to the paid up additions rider, suddenly our death benefit, of course, will go down, but the amount of cash value per premium dollar is going to go way up. And so what you'll see very common is put $3,000 to $4,000 of premium to the base premium, and $6,000 to $7,000 in that scenario toward the paid up addition rider. Now we're stuffing the PUA rider is just like a cash rider. It just stuffs cash value into a policy. It's a fancy word. It also does boost your death benefit as well every time you make a premium payment. So I think we've talked about that on the podcast before. We can go into more detail another time.
Have you ever wondered how to stop worrying and just make and keep more of your money? We believe in challenging the status quo. We believe in defying conventional wealth tools while maintaining traditional values. After all, most of those conventional tools only ever seem to make someone else on the inner circle rich. You can become debt-free, in control, secure, and achieve financial significance. Private family financing can be used in your life and even your business. Let us help set you free from worry. Visit livingwealth.com/freedom to receive your free copy of the Tree of Wealth. You'll learn about the tools banks themselves use and rarely speak about openly. These are the strategies used to launch Disney, JCPenney's, and countless successful families. For more than 46 years, Living Wealth has focused on treating clients with respect and honesty while helping them achieve financial freedom. Learn how to turn your hard work into significance. Visit livingwealth.com/freedom to instantly receive your free copy of The Tree of Wealth. You'll be enabled to have cash today and in the future. It's more than mere infinite banking. It's private family financing. Don't let banks and Wall Street dictate your financial future. Go to livingwealth.com/freedom to instantly receive your free copy of The Tree of Wealth. Now, back to Nate and Holly.
So Holly, why can't we just put all the money toward the paid up additions rider and not even worry about any death benefit or base premium?
The main reason is it's called a modified endowment contract. It creates a taxable event. Basically, what you've done is give the policy so much cash that now it's taxable versus the death benefit. So you have to have a balance. I guess the thing is that we want to get close to that MEC limit, but we don't want to exceed the MEC limit, the modified endowment contract, because we don't want to create a policy that you have to pay cash on.
Taxes on, right?
Yeah, the taxes on, like Nate said. Sorry, I said cash on, but I feel like
you do want a policy you pay cash on.
You do want a policy you pay cash on,
but not
you don't
taxes,
want a policy you pay taxes on, because then you defeated the whole purpose of starting the policy, which is tax-free growth. I think the other thing is that when you're using it just as a paid-up addition rider, it just becomes a single premium payment. Really, you're making really just a premium payment to get all cash and no death benefit, and the policy can't survive.
Yeah, well, I mean, it was back in the 80s where people were buying those single premium policies where they would just dump in $1 million, $2 million, $3 million. And it works like a paid-up addition rider. We're pretty much all on a single premium policy like that. It's pretty much just one big paid-up addition rider.
Yes.
And so all the money just goes to cash value. There's very little death benefit. It looked like an investment, and people were just living off the tax-free growth of the insurance policy. And it was around that time that the IRS said, it's pretty obvious you guys are doing this for investment purpose, not for life insurance. So we're not going to call this life insurance anymore. We're going to make this new thing. It's called a modified endowment contract, or a MEC. And they started taxing policies if they didn't fit the model and didn't pass this premium test called the 7-pay test. So there's a lot of mechanics that go on in there, but essentially what that is there needs to be a ratio between how much cash value you're stuffing into a policy compared to how much death benefit you have. And if you do too much, then you're going to create a modified endowment contract. The best way to build an infinite banking policy is to take the premium that you want, whether it's $10,000, $100,000 a year, any premium you want, and engineer that policy to where we have as much as we possibly can going to the cash value without crossing that line, because we obviously don't want to pay taxes on the growth. We want it to be called life insurance. So there is some limits to the PUA rider. We can't put 100% of the money that we're putting in towards the paid-up additions rider, but we can do a big chunk of it without meching it. And typically you may want to leave even a little bit of room. So like if the premium is $10,000, I prefer policies where the MEC limit might be $12,000 or something like that. That allows us to put in a little bit of extra money each year as we want to. That's not required. But that's another powerful thing about the paid-up addition rider is it's very flexible. We're paying into it, but the only premium that's ever actually needed is the base premium. So, it could be $3,000 or $4,000 is all we would need to pay in, but we can pay up to 12. We're planning on paying a total of 10, but we can pay up to 12, and anywhere really in between those two numbers for most insurance companies. Some people don't have as flexible riders as others, but generally there's some flexibility in how much you can put in or how little you can put in any given year.
Well, and I think that's a key point, Nate, is that it is a rider. So like sometimes we might have a really great year, which is why Nate said, hey, I like to put in that 7 pays $12,000. So I got a couple extra $1,000 maybe in a bonus or something I didn't expect, and I can actually put it into my policy.
Right, because if it was $10,000 was the MEG limit and $10,000 was your scheduled premium, you get a little bonus and you got a couple extra $1,000. You can't fit it in that policy. The only way to get it to expand is to open new ones, but maybe you don't really have enough. A couple $1,000, maybe would make a decent policy, but typically if you just have $1,000 in your pocket or $2,000 that you want to roll in, it doesn't really make sense to start a brand new policy on such a small scale. So yeah, exactly right. That's perfect. That's why we leave a little bit of wiggle room in there.
Let's say we had an off year even. Maybe our income went down a bit, or we're commission based, or we have a bad couple months. The flexibility of that rider allows us not to actually lose our policy and to maybe reduce it or take it down some. So I think that that's the key, is the flexibility of that rider. Let's say we had stuffed most of it into base premium, like a bad policy, I'm going to say, or the traditional policy would be, that's not flexible.
It's just we're paying the same premium for a long time and not even building much cash value.
Yeah. And so then if you have a bad couple months, you can't do anything.
Yeah.
And if you get a bonus, you can't do anything either, because you don't have that rider on there to put additional money into the policy.
Exactly right. So the PUA rider is like the oil that makes the machine run. Without that, it would be a little bit more difficult. It adds a whole world of flexibility to it and more profits to us, because we don't have to just go buy an all-base policy and wait 4 or 5 years for the thing to really start cooking. But that does bring us to the next point, which is how long should we fund the paid-up additions rider? Some people say for the life of the policy. Some people say for a short period of time. The question would be, how long is a good amount of time to build it, to capitalize a policy with a lot of money going in as fast as possible?
Well, Nate and I like to say, and I'm going to say traditionally, even when you would have learned even from Nelson, and that is, we want a minimum of 4 years. Sometimes we keep it on there longer based on age, whether they're older or younger, but you want to see that at least for 4 years. And then sometimes we don't drop it completely off either. So when you have extra cash, you have a policy to put it in. But I would say really the design of that comes with working with somebody who knows design, like Nate, myself, or somebody that you actually trust, that they're going to give you a policy and go through the explanation. What we don't want to do is keep that rider on there so long that your money doesn't become efficient anymore. And basically, I'm going to take Nate's $10,000 example here.
Mm-hmm.
Let's say we were putting $7,000 or $6,000, I'm going to say, to the paid up addition rider. And if we kept putting in that $6,000, we might get 11. We put in 10, we can borrow 11 out, maybe in year 5. But maybe in year 5, I only put in 4,000 and I can borrow out 6,000. Well, don't we want to put in $4,000, the less amount, to get more, right?
Yeah,
so that's the key, is when do we drop off that rider to the point where the base premium is now growing enough that you don't need to keep stuffing the policy with additional money that makes your money less efficient.
You don't really want to just necessarily pull the rider off the policy. You want to keep the rider on and the ability to fund it for as long as you can, because it's a great place to store extra money. But you are right. The policy we've ran, if once we've paid a premium, stuffing it with lots of PUAs for 4 or 5 years, you can actually see your profits go up when we drop off the rider and just pay the base premium. The base premium, while it looked terrible for the first 2-3 years, has now started to grow in its how much cash value is being produced per dollar that we're paying in. And so many times we'll see, on that same example of the $10,000 premium, we pay for 4 or 5 years with the paid up additions rider. And let's say after the 5th year, we don't pay the PUA. We just pay the base premium. Let's say it's $4,000. And many times we'll see that $4,000 produce $6,000 of cash value. Well, that's a 50% increase on my money, on my premium, to put in 4 and to get 6 back, tax-free. I'm feeling pretty good about that. So what can I do with that $6,000 that we're not putting into the paid up additions rider? We can just go start a brand new policy, get that built up to where it's 4 or 5 years old, and it's now growing by 50% above what we're paying in. My personal goal is to have as many policies as I possibly can that's growing by 40, 50% above my premium. I tell you, it's really not hard to find $4,000.
Yeah.
If we can get 6 grand back tax-free with no risk. There is kind of a crossover point where after 4 or 5 years, it may make sense. Not every case, but it may make sense to reduce or completely stop funding the PUA rider to free up money to go build a new policy. It's not always the case, but it certainly can be. If we kept funding the PUA rider, the policy still may be growing by, let's say, $2,000 of profit. So if I put in 4, I got 6. That's great. I could keep putting in 10, and I'd probably get about 12. Well, that's still the same amount of profit, but I had to put in 10 grand to get 2,000 of profit. I'd much rather put in 4 grand, get 6,000 back out, same profit, and then just go restart the cycle again and capitalize more policies. No one's ever had too much money in the bank. No one's had too much money in policies either. You can always use more policies. You can always use more profit.
in case you didn't catch it, like Nate said, I put in 4 and I get out 6, right? Well, that's 6,000 that you didn't have to do anything for the additional 2. You only put the 4 in. But the reality is, if you had put in the extra 6, you'd still be happy that you put in 10 and got 12 out.
Yeah.
But I'm not happy if I had to come up with an extra $6,000 for the same $2,000 of growth that I could have done at 4,000. So I think you really have to really understand and that the paid up edition writer is there to really give you that cash initially.
Boosters, yeah.
It is exactly what Nate said, the rocket boosters. And you don't always keep rocket boosters on forever.
You can't keep burning that fuel forever. And it is true on most policies that if you kept funding the PUA rider every year at the max level, at some point it would probably start becoming a mech and have to reduce it down. So without getting too complex, typically there's a kind of a crossover of efficiency where, hey, it might make sense after 4 or 5 years to reduce what we're putting into the PUA and start a brand new one. Not every case is that way, but that's why you would want to talk to somebody about your own specifics.
And I think that's why Nate and I really wanted to do this podcast, is so you guys understand our goal in our heart, even for our clients and individuals that speak to us, is to really make sure, number one, the design of their policy is correct.
Oh, yeah.
And we're not here to shove it into base premium. We're not here also to create a mech for you so you can't use the policy. The goal is really to create for you your own bank. And that's the goal. Remember, banks take money. When does it make sense to take off this paid up edition rider, and how long do we keep it on for, and how much do you put in?
As we mentioned at the very beginning, there's so much noise out there and distractions of how to build it, all these different bells and whistles. I have found that the simpler approach is almost always better. It's easier to grasp, and if you understand what you're doing, you'll know what to do. You'll know better how to work with the policy and use it. Whereas if there's a whole bunch of moving parts and term insurance and whatnot. Now, it is true, I put term insurance on policies, and I don't think we're really going to get into it too much, but the honest truth is we need to get back to the basics of what Nelson Nash talked about in his book, Becoming Your Own Banker, and get super focused on knowing what to do with these policies. We got to build them correctly. You got to know how to build them. You got to understand at some basic level what the paid up edition rider is, why we have it, how much we can put in without meching it, how long we should keep paying it. These things are some of the basic things that we need to get out of the way. But once those are in place, then it starts getting more fun because we can focus on how to use the tool. And that's where the real money is made, is proper use of the system.
I think Nate summarized it perfectly for you guys. Get back to the basics and stop the noise. Like, really look at the policy and the design and reach out to somebody who can help you with that design without all the noise interfering.
A lot of that noise, by the way, as we close this down, is really just to try to get people's attention, to say, I know some secret, I know some, whatever it is, just to try to get you to work with them. It's a marketing thing. And in reality, it doesn't change the long-term value of the policy in most cases. And sometimes it can actually creep in and hurt you, because many times to do these bells and whistles, we give control to the insurance company to change costs internally and some other things. So just be wary anytime people are trying to say, I found some secret, I found some new way to do it. There's a lot of complexity there. I prefer just to focus on what Nelson Nash taught us, how he built his policies, because we know it works and we know what to do with them, and we're not going to get blindsided by anything crazy. With that being said, this has been Dollars and Nonsense. If you follow the herd, you will get slaughtered.
For free transcripts and resources, please visit livingwealth.com/E95.